Everybody, thanks again for tuning in today. I have another video for you today that'll hopefully help you with any of your tax issues or tax planning items. Again, I am a licensed CPA. I have over a decade of experience within taxes, both individual, corporate, partnerships, all the above. So hopefully you find this beneficial. So today we're going to talk about estimated taxes, quarterly tax payments. Who needs to make these payments? What triggers the tax payments? And how can we avoid them? There's also interest and penalties associated with them if you don't make them and you are required to make them. So we'll talk about how those are calculated and also methods for eliminating this or just making it simple for you when filing your return, especially if you do it yourself. Or, I think it's helpful if you have a CPA or enrolled agent just to understand how they work instead of, having that particular individual just say, hey, you have to make these payments. I think always understanding the why is helpful. So, depending upon where you are, some states have income tax. So, if you live in a state like Florida or Tennessee, Texas, they do not have, those are just a few of the states, they don't have an income tax. So you don't really have to worry about the state component of it. However, majority of the states in the United States do have income tax. And majority of the states follow the IRS guidelines. So the IRS guidelines is the triggering event is $1,000. So if you have a tax due in any specific tax year of $1,000 or more, that next tax year you are going to be expected to make estimated tax payments. Again, the reason behind it, and we can kind of talk about how you can avoid it so you don't have to, especially if you're just a W-2 earner or there's something outside of the realm that maybe caused you to owe $1,000. But we'll get into all those details as we go. So again, that $1,000, typically states follow the same. So typically states follow the IRS guidelines. There may be some states that are outliers, but again, I won't get into specific states. We'll just talk about IRS guidelines for today. So there's your triggering factor. So again, if that $1,000 balance due at the end of the year, you will be required to make potentially four estimated payments. So they'll do $415, $615, $915, and $115. Now, if any of those days fall on a weekend or holiday, it would be due on the next business day. Again, this is taxes. These are estimated taxes as related to individuals. C corporations have a little bit different of guidelines, and their threshold is $500, and it is calculated differently, and the dates are slightly different as well. But we will just speak about individuals today. So individuals would be if you have Schedule C, Schedule E, if you have pass-through income, so from a 1065, 1120S, if you have trust income that comes through to you through a 1041, all those items are essentially passed through, and then you pay the taxes on the individual end. So this is really what we will be speaking about today. So kind of some factors to consider when you need to make estimated taxes. So there's two components in calculating estimated taxes or calculating taxes in general for the year. So there's what's known as a safe harbor provision. So the safe harbor provision is you'll pay in enough taxes that will eliminate you from having to pay interest and penalties regardless of what your tax due is at the end of the year. So even if your tax due is, say, $10,000 at the end of the year, as long as you paid in the safe harbor amounts, you will not owe interest and penalties for underpaying estimated taxes as long as you make that payment by April 15th of that particular tax year. Again, and it's due in full on April 15th. If you do not go under the safe harbor provision, you will be required to pay in that tax. And I'll get into specific percentages in a minute of what you're required to pay in. So again, if you guys find this video helpful, useful, please be sure to subscribe, press the thumbs up. I appreciate the support of anybody, and happy to provide any sort of additional information on my videos. So again, if you just help me by supporting the channel, that would be greatly appreciated and helpful. And I'll continue sending out videos on, and if there's anything you want to hear about that I'm not covering, feel free to leave a comment, and I will get a video out shortly on it. All right, so back to estimated taxes. So let's go with current year tax. So the current year tax, as long as you pay in at least 90% of your current year tax due, you will not be subject to interest and penalties for underpayment of estimated taxes. The safe harbor provision, if you're single or married filing separate, or head of household, is $75,000. So it's $75,000 and less if that is what you earn, as long as you pay in 100% of your prior year balance due, regardless of what your balance due in the current year, you will not be subject to interest and penalties for underpayment of estimated taxes. That threshold goes up to $150,000 for married filing joint individuals. And again, anything $150,000 or less, you pay in 100% of your prior year tax liability, you are covered from a safe harbor standpoint. If you are over the $75,000 for a single separate head of household, it's 110% pay-in of the prior year tax. If you're over the $150,000 income-wise for married filing joint, it's 110% of the prior year tax. That will safe harbor you. That will guarantee that you don't have interest and penalties for underpayment of estimated taxes as long as you pay the full balance due on 4/15. So, why would you want to do one method over the other? I typically would say to my clients is, let's do a safe harbor. It makes it easier. You're not prepaying the IRS money, that you don't need to pay. What if income changes? What if something changes during the year? So I usually like to say, let's do safe harbor unless there's a reason behind it. So let's just say you had an outlier year and you had additional income from dividends, you sold stock, or, you have a business and that business did exceptionally well, but the next year you're saying, yeah, you know what, I'm not really anticipating it, or, come tax time in April, it's not really looking as though our business is going to do as well as it's historically done. So, we're going to hold off on making our estimated tax payments. So you could do that, and, you can always re-up them towards the end of the year. But again, if things are going to somewhat stay status quo, I'd always suggest to pay in that 100% or 110% tax. So again, I would take basically, if your balance due, say it was $4,000, and if you're married filing joint and you make under 150, we'd basically say make 4 payments of $1,000. Do April, June, September, and January. Now, a lot of times where people get caught up is that you got to keep in mind is that April estimated tax payment that's due, your balance due for the year is also due. So if you have a balance due, so it can be a double hit, whereas you have an estimated tax as well as a balance due. So as you're planning your year and planning to come up towards tax time, you want to make sure that you have money set aside. You always want to make sure you anticipate. Always want to make sure that there's some money set aside so that and you can pay your taxes. That's why planning, I always feel like, comes to be an important aspect when doing your return, especially if you have a lot of untaxed incomes. You have business income, you have real estate income, you have dividends, you have interest, you have capital gains. All those items go into it, and you want to just make sure that you're covered and you plan for it and you don't have a shock at the end of the year. Which is why I'm always a fan of having a professional do your return, or just being caught up on tax laws. So by watching these videos, I think, it should definitely help you get caught up on tax laws and what you should be doing. So if any sort of income that varies on a year-to-year basis, I, again, would suggest, that you do the safe harbor provision. It's the easiest. You don't have to worry about it. Quarterly payments go. And again, if the other tricky part that comes up is IRS expects those payments equally. So again, if there's a quarter where you're short, there can still potentially be a penalty and interest. Not as much. It's just going to be on the amount that you're short. But there could be potentially a penalty and interest, and it can be up to 8%. So again, you just want to keep that in mind, why it's important to make those quarterly payments. Now, there is a method that you can get around that underpayment if you wanted to. Again, as as the year progresses and you're just like, hey, you know what, I didn't plan, maybe this year I didn't plan, or something happened and I had additional expenses, and I only have enough money for my balance due. Well, if you only have enough money for your balance due and you do have a W-2, and say you're a member of an S-corporation, so you have to take a salary out of an S-corporation. The way that you can do it is as the year progresses, and maybe November or December, prior to the end of the year, you can do a calculation, or you can have the accountant or whomever you use, enrolled agent, do a calculation and basically run a bonus paycheck, and have all that money that in the bonus paycheck, whatever the bonus is, just equal the total amount of your tax due in order to safe harbor you. That will eliminate you from having to pay estimated taxes during the year, because it's through W-2 withholdings, and then you will cover that 110% or that 100% safe harbor estimated payments as required by the IRS. That is the one way, somewhat of a little bit of a loophole that you can get around it. There is also, when you fill out the tax penalty form, you can also annualize your income. So meaning the IRS is automatically going to assume that your income was earned equally throughout the year. Now, again, if that wasn't the case, if you own a business and you had a large sale in December, then technically your fourth quarter would be a lot larger than, January, or, would be doing January, but your fourth quarter would be a lot larger than, say, April, because in April you didn't have that level of income. So again, those are items, that you can consider. The bonus component is definitely something that I always like to suggest, especially, if you don't know how your year is going to progress, and, you could say, hey, I got my year-to-date P&L, and, I run a business, and my year-to-date P&L shows that I'm having a loss, so guess what? I'm kind of just going to let things roll, and I think I got 90% paid in, or I think I got the 100% paid in. So I just kind of let things go the way they are. But then again, on the vice versa side, if, at the end of the year, you're like, I don't think I'm going to make it there. I had a great year, and I think I'm going to end up owing a lot of money in taxes. Then, you might want to consider doing that additional payroll withholdings. Now, again, you can, if you're filing joint, and as long as the company that your spouse works for, if your spouse doesn't work for you, and say you just have a C-corp or a partnership where you're not allowed to take a salary out of, you have to take it as a guaranteed payment or a draw. The way you can handle that is if your spouse works as W-2 job, you could see if their employer will allow them to increase their taxes. They should. If they receive a bonus, again, you should be able to change the W-4 just for the bonus. But again, something that you might want to have them check with their employer. But that's just something to consider. So if you do the withholdings on a W-2, you should automatically avoid, as long as you, like I said, as long as you hit those thresholds, the 90% current year tax, 100% if you make under 75, under 150 filing joint, and then over those two thresholds, 75 and 150, if you make over that, as long as you pay in 110% of the tax. Just to kind of give everybody a heads up, for state tax wise, state is similar for the most part. Again, specific states might have different rules, but for the most part, we're talking about 100% pay, and a lot of states don't have that 110% provision safe harbor that the IRS has. Majority of the states are 100%. So again, kind of taking that into consideration when you're doing it. And then again, it's just kind of knowing what you have for the year. You want to just know what you have for the year. And again, if the amount is smaller, the other option that you can do, if you don't want to do a bonus or you don't want to do it all in one shot, once tax time comes, just take that additional amount, and I think I mentioned earlier in the video, take the initial amount, divide it up, and have it withheld equally amongst the paychecks. As long as it's not that big of an amount, you might not even know the difference, and you know what, you don't have to worry about writing checks, you don't have to worry about coming up with the additional funds and the additional money to do it. So again, hopefully everybody found this video helpful. It's just somewhat of a brief overview of estimates and who has to make them and what's the triggering event, because I know a lot of times people have questions, especially if you use one of the bigger softwares, the do-it-yourself softwares, and at the end of it, they're just going to pop out estimates. And you're like, well, why do I owe estimated tax payments when I just have a W-2? And like I said, the reason behind it is if you make over $1,000 or more, it is IRS rules that you are required to make estimated tax payments. Now, whether or not you decide to do it, or you decide to do one of the other methods that I mentioned, so have more money withheld from your paycheck, do a bonus, or maybe you just have the cash and you want to pay it all up front at the beginning of the year, you can do that too. If you don't want to have to worry about 4 checks throughout the year, you can literally pay the entire amount in April, and then that way you'll avoid the interest and penalties because the entire amount was paid in April. Same holds true. So if you're getting let's talk about if you're getting, real quick, if you get a refund one year and you're already anticipating the next year, and you're like, well, I paid in too much estimates, and the next year I'm anticipating my income to go up, so I want to safe harbor myself. So I got to pay in either 100% or 110%. So instead of getting that refund, you can apply that to your next year's estimated taxes. And depending upon how much that refund is, you may or may not have to make an estimated tax payment. But again, like I said, it's personal preference. You can always have it refunded. You can have a portion refunded and still write the checks. So again, it's a matter of what you want to do, what your situation is, your specific situation is, what makes the most sense for you. But I would definitely strongly suggest that you at least put a reminder in your calendar so that you can be aware of when these estimates are due, and that they are due consistently each and every year. But I always encourage my customers, especially the ones that don't make them. A lot of people don't make them because you forget about them. So I like the option of either changing your withholdings if you can, or making a lump sum payment also if you can. It just saves stress, and then granted, you don't have access to that money and you're not earning anything on it, but at least then you avoid having to pay interest and penalties to the IRS, and hopefully theoretically you then will have a smaller tax balance due at the end of the year. And then keep in mind that your tax bill is always due on 4/15, regardless of what it is. So in order to avoid interest and penalties on balance dues, you have to pay it by April 15th. So there's two components to when you have a balance due. There is if it's over $1,000 and you didn't pay in at least 90% of your prior year tax, or vice versa, 100% or 110%. I'm sorry, 90% of the current year tax, or paying 100% or 110% of the prior year tax. There will be underpayment of estimated taxes that will be on there. And then again, if you don't make that payment by 4/15 or when the date is, if 4/15 falls on a holiday or a weekend, there will be interest and penalties on your balance due as well. So kind of just keep that in mind. I also want to use this as a moment to remind you as well, if you file an extension is not an extension of payment. It's an extension of time to file. So basically what that means is that if you're filing an extension, you should basically calculate and have all your tax documents together, have your return pretty much good and ready to go. You may be verifying a couple things, or maybe you're waiting for a document or two. And then you make your payment that you anticipate to make on 4/15. So then that way, when you file your extension, you're just, again, reconciling up what your actual tax due is, whether you missed a form or whatnot. It's safe to estimate it as well. But again, just anticipate if you have an additional balance due, there will be interest and penalties on extended returns if you pay it after 4/15. So again, I always like to exercise on the side of caution and make sure you pay enough money in when you file your extension, or you make that extension payment if you need to make one. But that pretty much covers it for estimated taxes or quarterly payments. If there's anything that I missed, feel free to leave it in the comments, or you just have any questions or looking for clarification, let me know. Again, and hopefully everybody likes and subscribes to my videos, and I'll continue posting.